Understanding C corporation tax requirements is crucial for business compliance and financial planning. C corporations must file Form 1120 annually and are taxed separately from their shareholders, creating a unique tax situation that requires careful attention. C corporations use Form 1120 to file federal tax returns and pay applicable taxes to the Internal Revenue Service. This process is more complex than other business structures due to the detailed forms and schedules that must be accurately completed. While limited liability companies that elect to be taxed as corporations also use Form 1120, S corporations use a different form, Form 1120S. The defining characteristic of C corporations is double taxation. The corporation first pays taxes on its profits at the corporate tax rate. Then, when those profits are distributed as dividends to shareholders, the recipients must report and pay taxes on that income on their individual returns. This differs significantly from pass-through entities like S corporations or LLCs, which avoid entity-level taxation. To mitigate the impact of double taxation, corporations can implement strategies such as reinvesting profits into the company, issuing reasonable salaries instead of dividends, and exploring tax-deferred benefits. Preparing for C corporation tax filing requires several key steps. First, confirm whether your corporation follows a calendar year or fiscal year for tax purposes. Then compile all financial documents, including income statements, balance sheets, payroll records, and prior year returns. Reconcile your accounting records to ensure bank statements match your books and resolve any financial discrepancies. Review all transactions to ensure revenue and expense entries are categorized correctly. Calculate depreciation and amortization, using Form 4562 to claim deductions for long-term assets. Finally, prepare Form 1120 and all accompanying schedules, including required forms like Schedule G for information on certain persons owning the corporation's voting stock. When filing, you'll need basic information, such as the corporation name and address, date of incorporation, total assets, and your employer identification number. Your financial officers should provide details about corporate income broken down by category, including capital gains, cost of goods sold, dividends, interest, rents, and royalties. C corporations can claim numerous deductions for business expenses. These include officer compensation, wages and salaries, maintenance and repairs, bad debts, rents, taxes and licenses, interest expenses, charitable contributions, depreciation, depletion, advertising, pension and profit-sharing plans, employee benefit programs, and domestic production activities. Some valuable deductions are frequently overlooked. These include startup and organizational costs, of which up to $5,000 each can be deducted in the first year, if total costs don't exceed $50,000. Business interest expenses are deductible under certain limitations introduced by the Tax Cuts and Jobs Act. While entertainment is no longer deductible, 50% of business-related meals still qualify. C corporations involved in innovation may also claim research and development credits using IRS Form 6765. The inventory accounting method you choose can significantly impact your corporation's taxable income. First in, first out typically results in lower cost of goods sold and higher taxable income during inflation. Last in, first out allows businesses to match recent higher costs with current revenues, potentially lowering taxable income. Specific identification works best for high-value or unique products, while weighted average cost offers a middle-ground impact on taxable income. For filing deadlines, Form 1120 is typically due on the 15th day of the third month after the end of the tax year, which for most corporations means April 15th. For years beginning after 2025, tax returns will be due by October 15th. If you need an extension, file Form 7004, which extends the due date to September 15th. Late filing carries significant penalties. If your tax return is filed late, there's a 5% penalty on unpaid tax for each month or partial month it's late, up to a maximum of 25%. Returns over 60 days late are charged either the tax due or a flat $135, whichever is smaller. The penalty may be waived if the late filing was due to reasonable cause. Beyond federal requirements, C corporations must meet state-level tax filing obligations, which vary by location. Most states require corporations to file an annual or biennial report and pay corporate income or franchise tax. Failing to comply with state obligations can lead to penalties, interest, and potentially administrative dissolution of the corporation. Accurate record-keeping and professional tax advice are essential for navigating C corporation tax requirements. Maintaining detailed documentation of all deductions and expenses not only streamlines the filing process, but also provides protection in case of an audit. With proper preparation and professional guidance, C corporations can fulfill their tax obligations while maximizing available deductions and minimizing potential penalties.